Okay, so you want to own an airline. Big fleet of planes with your logo on the tail, passengers, boarding by the thousands every single day. Every ticket sold, every bag checked, every seat filled is money in your pocket. Sounds like one of the biggest businesses on the planet. It is one of the biggest businesses on the planet. It is also one of the worst businesses on the planet to actually own, and almost nobody understands why until they're already holding the bag. Let's start with a number that should stop you immediately. Warren Buffett, one of the most successful investors alive, spent decades warning people away from this industry entirely. He once pointed out that if a capitalist had been present at Kitty Hawk when the Wright brothers took off, the smart thing to do would have been to shoot the plane down and save future investors an enormous amount of money. That's not a joke about turbulence, that's a joke about the fact that the airline industry, taken as a whole across its entire history, has destroyed more investor capital than it has ever created. And yet, people keep buying planes and building airlines anyway. So let's figure out why. First, what are you actually buying into? Because unlike a mall or a bank, you don't just build an airline and open the doors. You need a certificate from the aviation regulator proving you can operate safely. You need route authority, meaning permission to actually fly between specific cities, which for international routes often means government-to-government treaties that have nothing to do with you personally. You need landing slots at the airports that matter, and at the busiest airports in the world, those slots are not for sale in any normal sense. They are allocated, hoarded, and occasionally traded between airlines for sums that would shock someone outside the industry. A single pair of takeoff and landing slots at London Heathrow has sold for tens of millions of dollars for the right to use 5 minutes of runway time twice a day. You haven't bought a plane yet. You've bought the right to eventually buy one. Then comes the plane itself. A new narrow-body aircraft, the kind that flies most domestic routes, carries a list price north of $100 million. Though airlines almost never pay list price, they negotiate steep discounts, sometimes 40 to 50% off, because manufacturers desperately want the order volume. A wide-body aircraft for long-haul international routes can list well over $300 million. Multiply that by the dozens or hundreds of aircrafts a real airline needs, and you're talking about a balance sheet with billions of dollars in aircraft financing before a single passenger has boarded. Most airlines don't even own their planes outright. They lease them, often through aircraft leasing companies that specialize in exactly this, which means a huge chunk of an airline's monthly obligations look less like a retail business and more like a heavily financed real estate portfolio that happens to fly. There's a reason so many airlines lease rather than buy, and it comes down to flexibility that ownership doesn't allow. A leased aircraft can, in theory, be handed back when a route stops working or when demand contracts, whereas an owned aircraft sitting on your balance sheet has to be financed, insured, and depreciated, whether it's flying or not. But leasing carries its own trap. Lease payments are due every single month, regardless of how many seats you sold that month, and they're usually denominated in a way that assumes a certain minimum utilization, meaning the aircraft is expected to fly a certain number of hours a day just to justify the payment. An aircraft sitting on the ground isn't a cost you've avoided. It's a cost you're paying for nothing. Now you have planes, slots, and a certificate. Here's where the ownership structures start to matter, because not every airline is playing the same game. There's the full-service network carrier, the kind with a hub-and-spoke system, first-class cabins, and global alliance. Partnerships, the kind that treats a flight from a small city as a feeder into a massive connecting hub. There's a low-cost carrier, which strips out almost everything, charges for every extra, and tries to fly point-to-point with a single aircraft type to keep maintenance simple. And there's the ultra-low-cost carrier, which takes that idea further, packing seats closer together and treating the base fare as almost a loss leader for the fees layered on top. Each of these is a completely different financial machine wearing the same wings. The network carriers also do something the low-cost operators mostly can't. They sell each other's seats. Through global alliances and code-share agreements, a passenger can book one ticket that moves them across 3 different airlines' aircraft. and the airlines split the revenue behind the scenes according to formulas that took years of negotiation to settle. This matters because it lets a network carrier sell a seat to a city it doesn't even fly to, collecting a share of that fare purely for handing the passenger to a partner. It's a second layer of revenue built entirely on cooperation with companies that are, in every other market, direct competitors. So let's talk about how the money actually works, because the first layer, the ticket price, is far thinner than people assume. Across a normal year, the global airline industry as a whole often operates on a net margin in the low single digits, sometimes 3 to 5%, sometimes less, sometimes negative. That means for every $100 of ticket revenue, the airline might keep $3 to $5 after covering everything else. Compare that to almost any other consumer-facing industry, and it looks almost absurd. You are running one of the most capital-intensive, most complicated operations in the world for a profit margin that a mid-size restaurant chain would consider disappointing. Why is the margin so thin? Because the cost structure underneath a ticket is brutal and mostly fixed, regardless of how full the plane is. Fuel is typically one of the largest single expenses an airline faces, often somewhere between a fifth and a third of total operating costs and fuel. Prices swing with global oil markets that no airline controls. Labor is another enormous cost. Pilots, flight attendants, mechanics, gate agents, all under strict safety regulations that dictate mandatory rest periods and staffing ratios that can't be trimmed no matter how tight the budget gets. A pilot shortage across the industry in recent years has pushed wages up sharply at exactly the airlines that can least afford it, the regional carriers that feed passengers into the big hubs, squeezing a part of the network that was already running on thin margins to begin with. Airport fees, landing charges, gate leases, air traffic control charges, all fixed regardless of how many seats you actually sold on that flight. And then there's the plane itself sitting there, depreciating or racking up lease payments, whether it's flying full or half empty. A flight from one city to another costs almost the same amount to operate, whether 40 seats are filled or all of them are. That single fact is the entire logic behind everything an airline does next. Because if your costs are fixed and your revenue depends on how many seats you fill, then the entire business becomes obsessed with one number, the load factor, the percentage of seats actually sold on a given flight. Airlines have built an entire pricing science around squeezing that number as high as possible, and that science is called revenue management. It's why the price of the seat next to you on the same flight can differ by hundreds of dollars depending on when you booked, how far in advance, whether you're traveling on a weekend, whether there's a conference in that city that week. The airline isn't selling you a seat. It's selling you access to a seat at the exact price point that maximizes what the entire plane brings in, calculated by algorithms constantly adjusting thousands of fares across a network in real time. There's a rough break-even point on most flights, often somewhere in the neighborhood of 70 to 75% full, below which the flight is losing money, above which every additional seat sold is closer to pure profit because the fixed costs are already covered. That gap between a 70% full flight and a 90% full flight is enormous, and it's the difference between an airline's good year and its terrible one. Here's the part that surprises people the same way the gas station coffee surprised you. The ticket, the thing you think you're paying for, is often not where the real profit lives anymore. The real profit lives in the loyalty program. Airlines have spent the last 2 decades building frequent flyer programs that sell miles to banks who then give those miles to credit card holders as rewards. The airline gets paid by the bank for every mile issued, often well before that mile is ever redeemed for a seat, and sometimes never redeemed at all. During periods of financial stress, several major airlines have used their loyalty programs as collateral to raise billions of dollars in financing, and outside analysts valuing those programs independently have in some cases put their worth at more than the market value of the entire airline that owns them. Sit with that. The frequent flyer program, the thing that feels like a customer perk, has at times been worth more on paper than the fleet of airplanes, the routes, the slots, and the brand combined. The plane is the delivery mechanism. The loyalty program is the actual business. Layer on top of that the baggage fees, the seat selection fees, the priority boarding fees, the change fees, all of which for a low-cost or ultra-low-cost carrier can add up to a meaningful share of total revenue per passenger, sometimes rivaling the base fare itself. And layer on top of that cargo revenue, because passenger planes also carry freight in their belly holds, a revenue stream that barely registers in most people's mental picture of an airline, but that airlines lean on heavily during downturns when passenger demand dries up but cargo still needs to move. Now let's talk about how this business breaks, because it breaks in a very specific and repeatable way. The airline industry is one of the most cyclical, most externally exposed industries that exists, and that exposure comes from every direction at once. Fuel prices spike because of a geopolitical event on the other side of the world, and suddenly your single largest cost has jumped by a third with no warning and no ability to pass that cost through to a ticket. You already sold 6 months ago. A recession hits, and business travel, the highest margin category of ticket there is, evaporates almost overnight because companies freeze travel budgets long before consumers stop buying anything else. A single geopolitical event, a war, a health crisis, a natural disaster, can ground demand for an entire region, or in the most extreme case, the entire planet in a matter of days. While your fixed costs, your aircraft leases, your debt payments, your union contracts, keep accruing exactly as if nothing happened. Spent years running lean on cash, often because competitive pressure had trained them to keep margins thin and return capital to shareholders in good years, suddenly found themselves burning through cash reserves at a rate of tens of millions of dollars a day, with almost no revenue coming in the door. Assemble sat parked in the desert, still accruing maintenance and storage costs, still depreciating, generating nothing. This is the fundamental trap of the airline business. It requires enormous fixed investment in planes, crews, and infrastructure that cannot be quickly resized. You can't sell half a Boeing when demand drops. You can't furlough an airplane the way you can a shift of retail workers, not without real costs and real consequences for restarting later. Consider what happened to People Express back in the 1980s, one of the original low-cost carrier disruptors in American aviation. It grew explosively by undercutting legacy carriers on price, expanding routes aggressively, and for a few years looked like the future of the industry. Then it overextended, took on debt to acquire another airline, and got caught in exactly the kind of fare war and cost squeeze that this industry produces on a cycle. Within a few years, an airline that had once been one of the fastest-growing carriers in the country was gone, absorbed by a competitor. The pattern repeats across the decades under different names. A more recent version played out with a European long-haul, low-cost carrier that expanded aggressively into new intercontinental routes, taking on new aircraft and new debt at a pace its actual cash flow couldn't support. When a downturn hit, the same growth that had made it a media darling a few years earlier left it without the reserves to survive, and it ended up needing a state rescue package just to keep operating. An airline expands aggressively during a good stretch, takes on debt to fund growth, and then a shock arrives. Fuel spikes, a recession, a health crisis, and the same leverage that funded the expansion becomes the thing that sinks it. Eastern Airlines, once one of the largest carriers in the country, collapsed under a mix of labor disputes and financial strain. Pan Am, the airline that in many ways invented international air travel as a glamorous, aspirational product, went bankrupt and stopped flying entirely in the early 1990s after decades of financial strain compounded by a terrorist bombing that devastated its reputation and its finances at the same time. These weren't fringe operators. These were, at various points, among the most recognized airline brands in the world, and all of them eventually ran into the same wall. The airlines that have managed to survive and thrive long-term have generally done one thing differently. They treated cost, discipline, and financial conservatism as more important than growth for its own sake. One American low-cost carrier became famous in the industry for its fuel hedging strategy. essentially locking in fuel prices years in advance through financial contracts, which meant that when oil prices spiked dramatically in the mid-2000s, that airline was paying a fraction of what its competitors were paying for the same fuel, turning what could have been a crippling cost shock into a genuine competitive advantage. That's a rare example of an airline treating a commodity risk as seriously as it treats ticket pricing, and it's part of why that carrier went decades without a single unprofitable year, while much of the rest of the industry cycled repeatedly through losses and bankruptcies. But hedging cuts both ways. When fuel prices fall sharply instead of rising, an airline locked into a hedge can end up paying well above the market price for years, turning what was once a shield into its own drag on earnings. There's no version of this strategy that removes the risk entirely. It just changes which direction the risk comes. From let's actually run the numbers on what a single flight looks like financially, because the abstraction becomes a lot more concrete this way. Take a domestic flight on a narrow-body aircraft with around 150 seats. Say the airline sells the flight at an average fare of $150 per seat, and the flight departs at 85% full, meaning around 128 passengers. That's roughly $19,200 in ticket revenue for that single flight. Add ancillary revenue, bag fees, seat, selection, onboard sales, averaging maybe $20 per passenger, another $2,500. Total revenue for the flight, call it around $21,700. Now, the costs. Fuel for a flight of this length might run somewhere around $6,000. Crew costs, pilots and flight attendants, figured on a per-flight basis once you account for their full compensation and mandated rest cycles, might run around $3,000. Airport landing fees, gate fees, and ground handling might total $1,500. Aircraft ownership costs, the lease payment or depreciation allocated to that single flight, might run around $4,000. Maintenance reserves set aside for that flight hour might add another $1,800. Add in an allocated share of corporate overhead, reservations, systems, marketing, insurance, and administrative costs, another $2,000. Total costs for that single flight, somewhere around $18,300. That leaves an operating profit on that one flight of roughly $3,400, a margin of around 16% on that flight alone. Sounds reasonable? Now run the bad version of that same flight. Fuel prices spiked 20% due to a regional conflict disrupting oil supply, pushing fuel costs to $7,200. A soft economy means the flight only sells at 70% full instead of 85%, dropping ticket revenue to around $15,700 and ancillary revenue down proportionally to around $2,000. Total revenue falls to $17,700. Costs barely move because almost none of them are tied to how full the plane is. Total costs land close to $19,500 once the higher fuel is factored in. That single flight has gone from a $3,400 profit to an $1,800 loss. Multiply that swing across a fleet of 100 aircraft flying multiple times a day, every day, for months, and you can see exactly how an airline that looked healthy at the start of a year can be burning tens of millions of dollars a month by the end of it without a single decision inside the company actually changing. There's one more layer of fragility worth understanding, because it explains why this industry behaves so differently from almost anything else during a crisis. When an airline actually fails, it rarely fails quietly. Because the fixed costs are so enormous and the cash burn during a shutdown so severe, governments have repeatedly stepped in to prop up national carriers rather than let them collapse entirely, treating airlines less like ordinary private businesses and more like infrastructure too important to lose. That safety net has kept plenty of otherwise insolvent airlines alive far longer than a normal company in a normal industry would survive, which paradoxically makes the competitive environment even harder for a disciplined operator, because they're competing against rivals who never fully pay the price for years of financial mismanagement. So, does owning an airline actually work as a business? In the optimistic scenario, you've built or bought into a carrier with strong hub positions or a genuinely lean cost structure. A loyalty program throwing off steady high-margin revenue from bank partnerships, disciplined fuel, hedging, and enough scale to spread fixed costs across a large network. In a good multi-year stretch with stable fuel prices and steady economic growth, that airline can generate real, compounding profit and reward its owners handsomely precisely because so few competitors survive long enough to challenge it in every market at once. The industry's brutal economics end up acting as their own barrier to entry, and the few operators who manage the balance. She conservatively end up owning a shrinking, protected field. In the realistic bad scenario, a fuel shock or a recession or a global event of the kind this industry has weathered every decade or two arrives while you're carrying heavy aircraft debt. From an expansion that seemed reasonable at the time, load factors drop below break-even across the network simultaneously. Cash reserves that looked comfortable evaporate in weeks rather than months. And unlike a mall, you can't just wait quietly for a new tenant to sign a lease. Every single day, the planes aren't flying full. You are paying for a fleet, a workforce, and a debt load sized for a business that, at that moment, doesn't exist. An airline looks, from the outside, like a company that sells you a seat on a plane. From the inside, it's actually a leveraged bet on global fuel markets, global economic cycles, and geopolitical stability wrapped around a loyalty program that quietly does more of the real financial work than the flight itself ever does. The plane gets you there. The mileage account is what pays for the plane. If you made it this far, you probably think about money differently than most people. You don't just see a plane, you see the fleet financing, the leases, the hidden loyalty program quietly running the whole show underneath it. That's exactly the kind of thing this channel exists for. Every business you walk past every day is running on mechanics like this, hiding in plain sight. If you want to keep seeing the world that way, hit subscribe. There's a lot more hiding in plain sight, and I'd love to show you the next one.